For much of this year, I have been asked the question, why is the stock market continuing to go up? Well, in today's market update, we are going to give you that answer. Also, jobless data and any jobs data has been hard to find with the shutdown over the last 6 or 7 weeks. Well, we've got some for you. We've got that and much, much more. Let's dive into it. Now, before I get into the market update, just a reminder to like and subscribe to our page. That way you don't miss any of our future market updates. We appreciate it. Well, let's start off by the big question that I've been asked a lot throughout the year. Why is the stock market continuing to go up? There's been a lot of uncertainty out there for a whole host of reasons. We have been clear all year that the number one driver of the markets over the long run is company profits, and taking a look at growth in those all year is the most important chart. Let's get it up there. We've gone over this a couple times, and the reason we're bringing it up again now is we have just almost completed third quarter earnings season. But before we go over that number, let's look at this trend that's been taking place all year. The numbers on the lower part here, starting with 12%, are the estimate that analysts had for the S&P 500, all the companies cumulatively. What kind of growth are they getting year over year? So for the fourth quarter of 2024, these were announced from mid-January to late February. Expectations were 12% profit growth. It came in at 18.3. Now, it's not that unusual to have a beat of 1%, 1.5%, but over 6%, that doesn't happen very often. Then we got into first quarter reports coming out mid-April to late May. Expectations were 7% profit. That came in at 13.3. We got into the summer from mid-July to late August. That was second quarter reports. Only 5% expected growth. That came in at 12, another massive beat. And then our last video in October, we highlighted that for the third quarter, estimates were for 8% growth. Well, with about 90% of the companies in the S&P having reported, we can put up a chart that shows that number is 13.3%. I cannot remember a year where there were 4 different quarterly earnings seasons where companies were consistently beating by the amount that these have been beating all year long. And it's not a surprise that if you look back during those earnings seasons, which is basically about a 5 to 6 week period, the stock market has gone up during all of those time frames because the news has been so good. Now, a couple other things I want to cover here. So the first thing is on this chart, let's take a look at how some of the sectors have performed as far as growth, because a narrative out there by the bears on the market that have been very down on the markets all year is, hey, tech's doing well, but the rest of the market is not. Well, when we take a look at technology on the far right in blue, notice the growth year over year, 27%. That is just remarkable. AI is driving a lot of that, but it's not just AI. Let's look at 2 other very important sectors. First is industrials, up 19%. This is a very key industry that's tightly related to the economy. You don't get 19% growth there when things are going poorly. And then the financials, also very cyclical, up 23% year over year. We also have utilities up 22%, basic materials up 22%. So this is exactly what we want to see. This is a pretty broad earnings gain, and that's very positive. Now, the next chart we wanted to cover is taking a look at forward earnings per share, because the next narrative that those who are bearish have is, hey, it's just the large companies that are doing well. The smaller are not. Well, this is taking a look at what analysts think the S&P 500 and then mid-cap companies and small-cap companies are going to be earning going forward. And notice from about July on, the green line, which is small cap, has gone up significantly. Same with mid caps in the middle there, and then the S&P up top. So we have small, mid-size, and large companies all seeing and expecting to see very significant earnings growth in the year ahead. Now, the last chart around earnings, take a look at the number of companies that when they report earnings raise their guidance, their forward numbers, subtracting the companies that lower the numbers. So for example, if the line's going up, that's good. If it's going down, that's bad. This looks basically over the last 25 years. And you see some of the strong moves that have occurred there in the past at turning points in the market. And over on the far right, notice that this has gone up significantly over the last couple months. That's more and more companies raising the guidance. Kind of goes along with what we just showed you about large, mid, and small cap earnings all going up. Well, this is at the highest level in the last 25 years. If you take out that year period post-COVID, where truthfully every company's earnings got slashed significantly by analysts who didn't know how long the economy was going to be shut down. And so when companies started to outperform that, this raced higher. Outside of that time frame, things have never been better as far as analyst upgrades minus downgrades. We like to see that. Now, our next topic is taking a look at the jobs market. And the shutdown's been going on now 6-7 weeks. As we film this on Tuesday, November 11th, 11/11, the shutdown's expected to end late this week or early next week, which will be nice because a lot of the data that the markets rely on, we haven't been getting the last couple months, especially around the jobs market. One of the data sets, if you've been watching our videos for a while, that you know we rely on religiously is initial claims for unemployment insurance. When people are laid off, if they can't immediately find a job, they go file for unemployment insurance. This comes out weekly, which is very nice. The last time we heard on this data set, the numbers had been 216, 218,000 for a couple weeks there. They had come down a lot from early in September. Well, Goldman Sachs, because the government basically goes and gets this data from all 50 states. That's how they do it. Goldman Sachs said, hey, let's reach out and do this ourselves. The chart you're looking at is their version. You can see the dots. And the good news here is that this was for the week ended November 1st, 228,000. In other words, this is still on the lower end of the range that it's been at really for almost the last 4 years here. And we like to see this because the big question all summer heading into the fall was, hey, is the jobs market really weakening? Because there wasn't a lot of hiring being done. The phrase we used in our last video is this is a low hire, low fire economy right now. This is telling us that it appears that the layoffs are remaining low. Now, the next jobs piece of data we wanted to come to you with is taking a look at small businesses. There is something called the NFIB, Small Business Optimism Index. We've covered this before. It's every month, and this is a private company. Ask small businesses, how do you feel about the economy in your business in the months to come? And you can see that dipped a little bit the last couple months to 98.2, but it is a lot higher than it's been for most of the last couple years. When you go further and ask these small business owners about their business, the next chart asks, what's your single biggest problem that you have right now? And you can see here, taxes is for 16%, I guess, of these owners. Inflation is 12, poor sales is 10, and you go down. Look down near the bottom, quality of labor is 27. That jumped 9 points from last quarter. It's a big jump. Here's what they're saying. We're wanting to hire more people, but we're having a hard time finding qualified people. That is really good news to hear. What we don't want to hear is them saying, hey, we're not wanting to go hire people. We're not looking to hire right now. These owners are looking to a couple reasons why. One, we got the tax cuts extended over the summer. Now they know what are our tax rates going to be. Also, the Fed is back cutting interest rates again. They've cut rates twice in the last few months after taking a pause for about 9 months. We talked a lot about that. Lower rates is very important because for most small business owners, access to capital is very important, and rates were just too high for many to want to go borrow and expand. So when you add this in with the Goldman Sachs jobless numbers, it paints a picture of a jobs market hanging in there. Now, our next topic is gold. And if you got to take a second to say, if you have not watched our last video where we talk a lot about gold right off the bat, we had over 33,000 views, triple our biggest or most watched video to that point. And that's because we talk about some things around gold that most people didn't hear anywhere else. We want to talk more about it today, and we want to start off by going over what our main point was. If you take a look at when we filmed that video, gold had been on what we call a parabolic move. After having a nice steady move higher over the last couple years, it went parabolic here the last couple months. And we said, listen, this chart looks exactly like gold's chart back from 2006 to 2011. We'll put it up real quick. You can see again, steady movement high, then the parabolic move. We said, well, what happened after that parabolic move in 2011? Put that up and you can see gold dropped 45% over the next 4 years. Now, why does that matter? Because most of the people who piled in and bought gold after the big move were doing so thinking it was safe, it was secure, it was a store of value. Well, that is not the definition of something that drops 45%. We also have a chart of gold in the 80s and 90s. It dropped over 60% over a 19-year period. So it's important for people to understand that it's volatile. Well, we have a chart, a follow-up today that we did not have last time that we wanted to cover for you. This takes a look at asset classes. And so we're talking here about treasury bills, which are 3-month, 6-month treasuries, corporate bills, long-term U.S. treasury bonds, U.S. stocks, and gold between 1928 and today. So almost 100 years. This is measuring the average annual return here, up and down, and right to left is taking a look at volatility, called standard deviation. What I want to highlight is if you take a look at treasury bills and inflation, you're talking about a 3.5% inflation rate for a lot of that time. Treasury bills, you've made a little bit more, and there hasn't been a lot of volatility. As you work your way right to left, that's the amount of volatility. We'll take a look at U.S. stocks. You've had about a 12% average rate of return in that time, and there's been about a 20% standard deviation. That means there are some real volatility. The phrase we use is volatility is the price of admission for the kind of returns that stocks can give you. You're going to have times where the stock market has precipitous falls, but you make a lot of money in the long run. We'll take a look at gold. It's been even more volatile than the stock market, despite the fact the average rate of return has been just about half of what stocks have been. So listen, in general, you don't want to take on more risk for something that generally gives you half the return over the long run. It's about knowing the reason you want to own gold. And unfortunately, there's a lot of people who bought gold thinking it's something that it's not. So the key takeaways are the corporate earnings picture couldn't look any better for the 4th straight quarter. Results smashed analyst estimates, and that has driven the stock market higher. In the jobs picture, there's not a lot of data with the shutdown, but what we saw from Goldman Sachs and the Small Business Sentiment Survey told us that the jobs market is not a cause for concern. Well, thanks a lot for watching the video. Happy Thanksgiving to you and your family from us at Sentara Capital.